What's up, everybody? Whether you're on the side of the housing market crashers or on the side of the housing market recovery, the one thing you can't deny is that the affordability crisis in our country is out of control. In fact, according to the Atlanta Fed, housing affordability is worse now than at its peak back in the housing bubble of 2006. On Monday, Mortgage News Daily reported that the average 30-year fixed rate is 7.48%. The highest level since the year 2000, which only makes things worse. It seems like every time we get somewhat good news on the economy, the Fed steps in and raises rates, which then discourages would-be home sellers from putting their homes on the market. Fewer homes on the market creates a supply-demand imbalance, which will keep home prices high. So are we doomed to a future of high interest rate without any relief from home prices? Today, we're going to take a look at articles from Fortune and Market Insider to see what they're saying. So let's dive right in. In Lance Lambert's latest article in Fortune, he talks about deteriorated housing affordability by tracing it back to last year's rise in mortgage rates, which more than doubled, coupled with the pandemic housing boom, which pushed U.S. home prices over 40% in just over 2 years. The housing market is at a pivotal point as we head into the fall. Mortgage rates are now at more than a 2-decade high, and for some home shoppers, those higher rates are enough to cause them to step back from the market, wrote Lisa Sturdivant, chief economist at Bright MLS, in a statement to Fortune. It is likely to be a very slow fall in the housing market this year. Home prices, which had rebounded this summer, will dip in some markets as new listing activity increases at the same time a segment of the home buying population sits the market out. The markets that she thinks will see a dip in home prices are the same markets that overheated during the pandemic boom, namely markets like Boise and Austin, or markets that were already unaffordable. Apart from the overheated markets, Sturdivant doesn't expect any serious home price corrections due to the lack of inventory and overall healthy economic conditions. The markets at greatest risk of price declines are those where affordability challenges are the worst, including some West Coast markets, as well as places where prices have run up quickly, including in parts of the Sun Belt, Sturdivant says. But while the current affordability crisis seems eerily similar to the years leading up to the 2008 housing crash, the two situations are vastly different. Unlike the years leading up to the 2008 housing crash, we're not grappling with an excessive surplus of existing homes for sale. In fact, housing inventory levels are hovering at historic lows, with July 2023 witnessing a staggering 47% declines in home available compared to July of 2019. In addition, our current housing market is not subjected to the subprime lenders, which let people borrow money that they simply couldn't afford, creating an onslaught of foreclosures and short sales when the payments increased. In fact, this crisis was caused by people having almost too much purchasing power to buy homes wherever they wanted if they could work from home, with the historically low interest rates that were created during the pandemic. So here we are with the worst affordability crisis yet. The question is, how and when will it end? Jennifer Son writes in Market Insider that Fannie Mae economists believe the housing market isn't coming out of a deep freeze anytime soon, even if the U.S. economy manages to steer away from a recession in the next year. With an ongoing tight supply of existing homes for sale and the recent rise in 30-year fixed mortgage rates to around 7%, we expect home sales in 2023 to remain near the lowest annual level since 2009, Fannie Mae economists said. Regardless of whether a soft landing is achieved over the coming year, we expect existing home sales to stay subdued and within a tight range. That's because in order for the United States to avoid a recession, the Fed will keep interest rates elevated, which will influence mortgage rates to stay high as well. In the event that the U.S. does fall into recession, interest rates will likely dial back somewhat, Fannie Mae economists reported, which could cause mortgage rates to ease slightly. But the housing market would still likely be affected by a weakening labor market and an ongoing crunch in credit conditions, in addition to dampened consumer confidence. We therefore do not anticipate a meaningful recovery in existing home sales over our forecast horizon under any of the more likely scenarios, Fannie Mae said. Lambert writes that the path to improving housing affordability moving forward rests on three key levers: rising incomes, declining home prices, or lower mortgage rates. Among these, mortgage rates hold the greatest potential for short-term impact, as we've seen over the past 3 years. Whether the Fed has lowered rates or when they made them higher, each time the impact is felt in the housing markets. So will rates come down? The Mortgage Bankers Association released their forecast on Monday that anticipates a decline in interest rates to 6.2% by Q4 of 2023, and then further down to 5% by Q4 of 2024. And they're not the only ones forecasting a drop in interest rates. I did a video recently where we went through different industry experts' opinion on rates, and some of them were projecting them to go down, including CoreLogic's chief economist Selma Hebb, who thinks that rates will come down to the mid 6% range by the end of 2024. As people run out of their savings left over from the pandemic, spending will begin to slow and the economy will begin to slow as well. Also, gas prices are rising along with food prices, which will impact household spending, something the Fed pays very close attention to. At some point in the first quarter or second quarter of 2024, the Fed will need to offer relief to these households by cutting rates to lower the cost of borrowing. However, expect elevated mortgage rates to finish the year between 6.5% to 6.8%. And Mike Hardy, which is the managing partner at Churchill Mortgage, is even more bullish. Looking into the crystal ball, I see mortgage rates heading down over the next 6 to 12 months, with some volatility accompanying this downward trend. I think 30-year rates will be in the ballpark of 5.25% and 15-year rates to be around 4.875% a year from now. I don't know about you guys, but this seems a little far-fetched to me, but comment below and tell us your opinion. Like I said at the beginning of this video, whether you're in the crasher camp or the recovery camp, you can't deny that we have a serious affordability crisis on our hands. Something's gotta budge, and I'm hoping that it's interest rates. If they come down to a reasonable level where would-be sellers will put their homes on the market without having to sacrifice too much with their already low interest rate, this will create a lot more inventory for buyers to choose from. Of course, home prices would have to be affordable as well, and if you believe Barbara Corcoran, that's not gonna happen. Just the other day, she said on Good Morning America that if interest rates come down, she expects home prices to go up as much as 15%.
Every buyer on the sideline is going to jump into the market as long as the interest rates come down to 5 or 4%, and houses are going to go up in price all over again. I wouldn't be surprised if they go up by as much as 10 or 15% when that happens.
So what do you guys think? Definitely comment below. And like I said, if you missed last week's video, check that one out next. Thanks for watching. I do appreciate it. Bye!